Another sea of red on Wall Street today. All three major indexes posting declines, with the Dow dropping 223 points. With markets approaching correction territory, maybe you should be considering buying on the dip, but could stocks still be too expensive? We're covering your assets tonight with Anthony Sacchero, the president of Providence Financial, Jeff Taylor, a co-founder of Digital Risk, and Jeff Levine, a retirement consultant for Ed Slott and Company. Welcome all. Jeff Levine, I will start with you.
Thank you.
One of the interesting things about the trading today is that the market took a huge plummet when there was a plane in Boston at the airport there. I think 4 or 5 people were sick. Emergency personnel came in and the market sold off. I'm surprised that the market would sell off from Ebola. What's your analysis of that, Jeff Taylor?
Today, watching the markets basically sell off today on Ebola, it just goes to show you how the area that we're in is sort of event-driven right now. So, I mean, we've been talking about, do we have a bubble in sort of equities, different stocks, but really I think it's going to be some of the more macro global issues which are going to really drive a lot of the volatility, we're going to say, day to day. Now, we also have certain stocks on the tech sector that
All right. Let's drill down to that in just a second. I'm going to go to Jeff Levine.
Okay.
What do you make of this? Is this the kind of market we have where we're trading on event risk?
I think that's exactly what's going on right now. Anything that goes on anywhere could make a huge difference in what the market does. I mean, we saw just a plane full of passengers made a huge difference just in an hour at the end of the day. Unbelievable.
Anthony, to you, we're closing in sort of on correction territory. The S&P 500 down 5.8%, 10% is a correction. Are we going to go there before Christmas, before Thanksgiving, before Halloween?
Yeah, I don't know exactly when we're going to go there. We are going to go there. There's no question about that. And I'm going to say something that the mutual fund companies won't say and that the stockbrokers won't say. And I think we've got a long, long way to go. If you look at history, there have been many times in the last 100 years, including in the last 15 years, where the market has dropped 55% in 2008 and 45% in 2001. And I think we can be back in that territory. And all the numbers show that we... Absolutely.
Why?
Absolutely. Well, there's a lot of reasons, but Jeff Levine was right, and that is that anything right now is going to cause the markets to topple. The scales are just like this, and it's one little feather on the wrong scale can cause the entire market to go like this. We've seen it before.
You know, I respect you, but I certainly hope you're wrong.
I hope I'm wrong too. I hope I'm wrong too, but it's happened many times.
Jeff Taylor, to you. You know, we look at this market, but we're also considering interest rates here. And I want to read to you a quote from Stanley Fischer, the Fed Vice Chairman, about this rate hike delay that could happen. If foreign growth is weaker than anticipated, the consequences for the U.S. economy could lead the Fed to remove accommodation more slowly than otherwise. What do you expect?
I definitely expect that the rates are going to be going to rise very, very slowly. Look, Yellen gets it right now. Any significant rate hike is not only going to hurt the corporate market, but also the housing market, which really hasn't come back yet. So from a corporate perspective, I think that we're going to see maybe the slowdown in some of the buyback stock programs that have been going on. But also look at the housing market right now. We had a 19% increase in new housing sales last month, while the rest of the housing inventory generally stayed flat. What that shows is there is an interest in these millennials buying houses in the right areas of the country, but you just have to be with San Francisco, Washington, and Miami. You just have to be buying them in the right areas.
Oh, boy. Jeff Levine, to you, what's the impact of this pullback in the time frame that rates might rise? Is that going to be good for stocks?
Well, you know, it could be good for stocks, but it could also be bad for a whole section of the population. I can tell you every year for the last number of years, if clients have come into the office, they're seeing their taxable interest, what a lot of retirees live on, just drop like a rock. So there's a whole segment of the population that's waiting to see these rates rise and is not getting the relief that they were hoping for as well.
Anthony, what are your clients telling you? I mean, look, we hear from retirees who are apoplectic about what's happened with rates. On the other hand, if you were in the stock market, you're super happy.
Yeah, absolutely. When it comes to the savings, the interest rates being down are not good for savers and people that have done well enough to plan on using their dividends and interest to be able to live off of. These people are getting hurt badly. And the challenge is that while the Fed talks about the fact that the rates are going to go up in 2015, if the market has a severe pullback, as I think and as history has told us that it will, the rates will not move. They're going to stay down for a long time. I think Japan's a good example of that. And I think individuals that are retired, living off their interest and dividends, need to be prepared for low rates for a long time to come, maybe 5 to 10 years.
Jeff Taylor, to you, the S&P is trading at about 18.6 times earnings.
Yep.
Is that expensive? Is that cheap? Does that mean, go load up the back of the truck? What does that tell you?
I think that historically S&P is trading a little bit higher than it generally has. But again, I would tell you, sort of contrary to what we're hearing a little bit, the low interest rates, while it might not be great for the stock market, if there are people looking to get into the housing market right now, it's a once-in-a-lifetime opportunity. And generally, economic recoveries are always driven by growth, by people buying houses, household formation, et cetera. So that's a very important part that we got to keep talking about. So low interest rates aren't going to all be bad.
Well, I hope you're right about that. Jeff, Anthony, and Jeff, thanks for coming on the show tonight. Appreciate your time.